Good afternoon, everybody. My name is Mary Gordon, and I am one of the National Account Managers here at Harbor Capital Advisors. I am very excited to be kicking off today's ESG discussion. To give you a little bit of backdrop on why we put today's call together, my colleagues and I here in National Accounts have been hearing how much ESG is top of mind for our manager research and product management contacts at various home offices. As such, we thought it would be both useful and timely to leverage our relationship with two well-respected asset managers who both have expertise in ESG and who manage funds for Harbor. It's worth noting that the audience today for this call is 100% home office gatekeeper personnel. So if you would like to geek out and ask something really nuanced, you are amongst your people. So we encourage you to go for it. So I am going to advance the slide here and share a little bit of information on who you are going to be hearing about today. I will soon be handing over the floor to my colleague, Joe Duffy, who is a member of Harbor's investment specialist team. Joe is going to be serving as our moderator today. We also have from our investment partners, very pleased to have Zak Smercrzak from Comgest and Allison Walsh from Income Research and Management, also known as IR&M. To give you a sense of their responsibilities, Zak is a portfolio manager at Comgest. Comgest, of course, is an international equity manager that emphasizes quality and sustainability in their investment process. And then Allison is the head of ESG and corporate sustainability at IR&M. As you may know, IR&M is a US investment grade fixed income specialist that has ESG embedded into their investment process. So clearly, Zak and Allison are both well suited to offer their ESG insights, Zak from the equity perspective and Allison from the fixed income perspective. So let's advance to the next slide. For those of you who might appreciate just a quick high-level refresher on Harbor, if someone were to ask me who is Harbor, I would say Harbor specializes in identifying best-in-class specialist asset managers and then hiring them to sub-advise a Harbor branded investment solution. So the Harbor family of funds employs a number of high-quality managers who have been thoroughly vetted by Harbor's research team. A couple of high-level stats on Harbor. We have a 35-year track record. Our firm was founded in 1983, and we are headquartered in Chicago. We currently have just over $62 billion in assets under management, and that $62 billion is spread across our 22 different investment strategies, which are run by 17 distinct investment managers across 17 asset classes. In terms of what is on the horizon for Harbor, I'll just quickly mention two things. Number one is vehicle expansion. So Harbor has historically been a mutual fund only shop, but today we now offer a selection of CITs. And just as of a few hours ago, some breaking news, our very first actively managed ETFs were launched. So today's a pretty historic day for our firm, and the launch of ETFs is a huge milestone in our vehicle expansion efforts. The other item on the horizon is multi-asset portfolios. So earlier this year, we formally launched our first multi-asset offerings and are working on rolling out a disruptive innovation thematic portfolio fairly soon. While the multi-asset effort is a milestone in that Harbor is managing portfolios after many, many decades of not doing so, it's important to point out that this doesn't influence our existing funds, and our sub-advisors still have total autonomy over their portfolios. The multi-asset offerings are separate and distinct from our single manager strategies. So with introductions and the Harbor refresher complete, let's kick things off. We're going to have about 45 to 50 minutes of dialogue, and then we'll devote about 10 minutes to Q&A. That said, I cannot emphasize enough that we want this to be conversational. So you are hereby officially encouraged to jump in at any time. No need to wait for the Q&A. You can either type your questions into the chat box, or for the more daring amongst you, you are welcome to just turn your camera on and ask your question via video. Nothing would make us happier than to have an avalanche of questions and comments today. So the gauntlet's been laid down. Joe, I am going to put the agenda up on the screen for you, and the floor is officially yours.
Thank you, Mary, so much. So just a quick agenda for today's discussion. It seems like there are just a number of different descriptions of ESG across the asset management landscape. And so both of our panelists will define ESG, what it means to them in their organizations. There are also a number of third-party ESG data and ratings availability providers. And so we'll dive deep into those and assess strengths and weaknesses, as well as where coverage pitfalls may exist. We'll also talk about ESG from both the macro and the micro level. From the macro side, we keep hearing that the ESG opportunity set continues to expand in terms of number of availability of securities, as well as companies embracing ESG, as well as issuers. And then we'll look at, from the micro side, how companies score well on each firm's ESG criteria, as well as companies and issuers that may not score as well, and we'll see details on that as well. Lastly, I'll provide an executive summary. We'll answer any lasting questions. And certainly, if you guys have questions, as Mary said, feel free to type them in or certainly pipe in via the live data feed. So with that being said, Mary, if we could drop down the slides, we'll kick off the conversation. Both Allison and Zach, we really appreciate you guys taking the time. We appreciate your participation as well as partnership. Allison, I'll ask you the first question. Zach, feel free to follow up, work off of each other, keep this conversational. We certainly want to keep this interactive. And certainly, as I mentioned, there are just a number of different descriptions of ESG across the industry. Allison, can you please provide how you specifically define environmental, social, and governance investing per IRNM in your perspective?
Sure. Thanks, Joe. Hi, everybody. Thanks for having us. Income Research and Management has really implemented ESG for a number of years, and we view ESG analysis as an integral part of our risk assessment when we're evaluating securities. So we're a bottom-up security selection shop. We believe that ESG and looking at the material, environmental, social, and governance factors that impact companies, municipalities, and securitized assets really help to drive our analysis. And we believe that this ESG integration leads to a more holistic view of the credit. So we've implemented ESG across all of our strategies and think that that's really additive to our research process.
In much the same way as Allison, then, Comgest, which, by the way, Joe, has also been around for 35 years. And our philosophy is very much bottom up, as is Allison's. And part of that bottom up due diligence that we do is predicated predominantly around the quality. And our definition of our quality framework, if you will, has, for that 35-year period, always encompassed elements of non-financial due diligence. So things around the social utility of the business, whether it be concerned about all stakeholders, tax, employees, whether it be around environmental footprints, management incentivization and governance. And those elements of quality have been more formalized, I suppose, in the last 10 to 15 years as ESG has become more and more of an important focus area. So it's part and parcel of, and always has been, of our quality definition. But it's not just a box ticking exercise for us. It must be focused on important material, attributes that have an impact to the investment thesis, which drive the quality and the sustainability of the business model and franchise for the long term. Because if the business is not sustainable, it is not going to be growing for a long period of time. And as long-term quality growth, sustainable growth investors, then that's very important for us.
Great, thank you. Moving on to the next question, maybe we'll start with Zach. We keep hearing that ESG is somewhat of a European-led situation. Would you say the US is behind Europe in terms of ESG adoption? And what could we expect here in the States using Europe as a guide? Is it future complexion shifts in the benchmark framework? I guess more importantly, maybe increased disclosure regulation. What regulations are currently in place and what can we expect to see in the coming future? And if there are acronyms, please feel free to break those out for the audience.
Absolutely, sure, Joe. It's a good question. I think let's try and tackle it in two parts. One is the US behind on ESG? I would say, absolutely not. The US is a thought leader, if you will, on a number of things, whether it's governance or sustainable business models and the like. As a fundamental bottom-up stock picker, I can assure you there are companies that we invest in that are well ahead on that maturity curve versus those, for example, in less developed markets, particularly Asia. So from an investment perspective, then that I think it's a bit too harsh a statement, but from a regulatory perspective, then I think yes. So the European market is slightly ahead in terms of the regulatory framework. So you mentioned a couple of acronyms, and then you have SFDR, and to spell that out, so it's a Sustainable Finance Disclosure Regulations, and NFDR, or Non-Financial Reporting Directive. There we go. And those are sorts regulations that have been brought into place to try and provide a framework here in Europe for both investors and for corporates to provide some sort of structure which allows some benchmarking, some peer comparison, but more importantly also to prevent greenwashing, particularly as it relates to people on the investment side, creating funds with pretty marketing presentations saying, we're ESG without actually being genuine, but also on the corporate side, trying to just tick boxes and appeal to an investor base. And so the regulation is welcome. It's needed. It's still not yet completely settled. But I think the US will probably, you'll probably see more and more of that coming to the fore. I think it was just last week or the week before, the SEC was announcing some reviews of some asset managers for, greenwashing or whatnot. So I also know that the regulators are talking to one another more and more. So you should see some more of that coming to the fore in the US. I do hope it doesn't go down the road of sort of Sarbanes-Oxley sort of, box ticking checklists of sorts, and it is a bit more pragmatic, a bit more fundamental based, but provides some structure and rigor to what it is we're talking about.
Yeah, I'd 100% agree, and we don't like the box ticking either. It really doesn't allow for that common sense overlay either. One of the things that we're thinking through is how these European regulations, because they are a little bit ahead of the US, how that may influence what happens here. So Zach mentioned the SEC certainly focusing on this. They had received over 6,000 responses to their request for comment on climate disclosure. It's certainly been in the headlines about how they're thinking about this. And so we expect something to come forth. And I think, again, to Zach's point, it really will be beneficial. We don't expect them to be exactly alike, but to have different regulatory regimes for ESG, it will be difficult to report to all of that. So we're hopeful that these conversations that are happening globally will allow the regulations and the reporting requirements to be hopefully somewhat similar, so that we're getting information that we can compare across our investments, but also what we're needing to provide as an asset manager from a reporting perspective. So those are a couple of the things that we're just watching and providing our feedback where we can.
Great, thank you for those perspectives. And moving on to kind of the next section around third-party data providers, and we'll steer this one to Allison to start. Allison, is IRM incorporated and formalized ESG within your investment construct? Did you guys evaluate certain vendors, third-party data providers like Sustainalytics and MSCI? What were your findings in terms of strengths, weaknesses, and are there any coverage gaps in terms of some of the areas that you guys emphasize within fixed income?
Sure. So we certainly evaluate data providers on a regular basis still. I mean, the good news is that there's more and more data available, and the data is getting better and more accurate, more timely. We still certainly have a number of gaps and things that we would like to see, but we're getting more and more, we're having more discussions with more data providers. But we did, as a firm, talk through our, whether we would go with Sustainalytics or MSCI for ESG rankings. And, as bottom-up fixed income security selector, we evaluate these securities using a lot of different data sources. And so these ratings providers were really just going to be one additional data source. We don't necessarily need to use these ratings as a like Zach said, a check the box item, but really just we're looking at it from the perspective of one other analysis on a credit. And so We do have our own internal ranking system for ESG. We have ESG leaders and laggards based on the sectors that the analysts are covering. And when we evaluated Sustainalytics and MSCI, we found that both companies had a lot to offer. But what we found was that MSCI's analysis really aligned with how we thought about ESG from the sector level perspective, particularly, but also just in general. Their robust research platform that we had access to if we were to sign up with them was pretty impressive, and their timeliness of updating their responses and their reviews based on events that were happening was also pretty impressive. So we did feel that we had good access to their research analysts, and again, their information was updated pretty timely. So one of the other major differences that we found was that Sustainalytics risk rankings measure the magnitude of a company's unmanaged ESG risk. And that is really, it's an absolute score across industries. So in one way, it's great because you can compare across industries. But we tend to think about this from more a sector level perspective. And so MSCIs are rated at the sector level. So are you leading within your industry from an ESG perspective? So not comparing a technology company to an oil and gas company, or another different sector that really has different ESG considerations. And so we found that aligned with our overall philosophy when we were looking at them.
It's really interesting that you say that, Alison. So with the Sustainalytics, you like the fact that there's this, you can compare and contrast across sector. Is that right?
Yeah, you can compare across the sectors with their rating.
Excellent.
But we've found that in order to have a diversified portfolio, and the way that we think about ESG as a risk within a company and its sector, it really made more sense for the way that we were aligning our thoughts with how MSCI thought about it, which, coincidentally is also how SASB's materiality mapping seems to work, where they're focused on what is material for each of those sectors, and they've mapped out those different issues. So we have a very similar key issues framework that incorporates a lot of the things that our analysts have gone through and said, well, within this particular sector, these are the key issues that are going to impact our credit view. And those are going to be different for each sector. And MSCI also focused on a lot of the same things. So we were looking for more detail in the key issues that we were looking at for each of those sectors.
That's good. I mean, it resonates with us too, because we certainly like MSCI research. We kind of find them as a bit of a jack of all trades. They have an excellent quality assurance capability, making sure the data for us, at least from our experience, is sort of relevant, timely, and updated. But they're also, the analysts are also quite available in terms of time to answer any questions that, if we have any. But stepping back from these, from the rating agencies and MSCI in particular, we pay a lot of money to a lot of people for these ratings, like MSCI. You mentioned Sustainalytics, True Cost, a few others, Rep Risk, for example. Then we have our own internal ranking system and rating system. It's a 1 through a 4, and what we try and do is use our own in-house experience and peer and benchmarking and peer comparison, if you will, within sector or even across sector, to come up with our own ratings and leverage off of the inputs from all of these providers. So we do like MSCI research. We obviously use Rep Risk. Rep Risk is great for any sort of controversies, board level, litigation, investigative pieces, or journalistic pieces of sorts. And Sustainalytics we found is good, very broad, but perhaps for us, we found it spread a little bit too thin, and don't have as strong, for us, again, our own opinion. Don't shoot the messenger, Alison. In our opinion, is that they're not as good in terms of quality assurance versus MSCI research, for example. But we, when we build our own ratings of 1 through 4, we do try and focus, much like you said, Alison, not ticking a box, and we've said many times, we do try and focus on the material issues. So if it's whether it's data privacy and protection in tech, or whether it's environmental damage in in dairy. And that materiality focus for us is far more meaningful and impactful than having a score on every metric of E, S, and G. It's the materiality of the issues which we focus on within our ratings.
Yeah, and I think one of the other questions that you had proposed, Joe, was just how they're different and whether that's okay. There's certainly been a lot of headlines about the fact that these ratings from MSCI and Sustainalytics and other ESG rating companies are not correlated. And we've come to the understanding that it's okay from our perspective, because like Zach said, we're creating our own ratings. These are, just one piece of the puzzle that we're looking at when we're making our analysis. And you really just need to understand the methodologies behind each of these data providers. We ran into one situation where a company that was rated by MSCI, they had one board member change and the rating was changed. We didn't find that was as impactful. And again, I think it was part of the checking of the box where, it hit one additional thing that caused MSCI's formula to move it down into the next rating level. And we felt like this didn't warrant that move. And so that's where we kind of allow ourselves to look at this and understanding where they're coming from and why that may have happened, their rationale behind it, but ultimately being able to disagree and put our own analysis together.
Alison, I'm just curious. One thing that I've actually quite enjoyed with, here in Europe, the non-disclosure financial reporting, for example, companies are reporting, self-reported, of course, which is a risk in of itself, more and more data around ESG, which allows us to do more of our own work and actually rely less and less and less on these rating agencies, to some degree. And so I was just curious, just to extend that, so the United Nations Sustainable Development Goals have come more and more to the fore, and I'm seeing more and more companies publish information on it. And we, instead of just accepting those ratings, then we'll actually sort of due diligence and sensitize those ratings, because they are self-reported to some degree. So I was just curious, do you use the SDGs at all in your analysis?
We look at them, but we haven't found a great way to measure how a company is utilizing them, impacting that, how their operations are impacting the SDGs. Like you said, it's self-reported, or it's another company looking to see whether their revenue goes towards one of the different SDGs. And we just haven't found that it's been super reliable. It's certainly one of the things that we think about, but we haven't looked at that in depth. It's one of the, it's one of the things that, again, is part of the thought process, but it's not something that we're tracking.
No, you're right. I mean, it's self-reported, so of course these things are self-reported, so you need a level of skepticism, shall we say, or cynicism.
Yes.
Zach, Allison, looking across asset classes, are there coverage limitations in leveraging the ratings data? Meaning, are there more esoteric areas of your markets that don't have ratings that you guys have to go kind of one step deeper within?
Yeah, I can start with that. From a fixed income perspective, we're looking at the corporate universe, and that seems pretty well covered. But when you get down to the municipals and the securitized asset classes, that's really where we run into a lot of trouble gathering data from one source in particular, but just in general. So I will say that the data providers are looking at this, they're aware of this. There are different data providers that are focused just on municipals. And so we've heard from them. A lot of it is based on zip code data. So they're kind of looking at where is this municipality located and do they have wildfire risk or flooding risk, et cetera, and not necessarily overlaying of opinion, but again, good data points that we might be able to use at some point, but we're really having to do a lot of our own digging within that space. And then on the securitized front, there's just a number of different layers that you really need to consider, and there hasn't been a data provider that has been doing that. And so, are you looking at the servicer? Are you looking at the issuer? Are you looking at the underlying assets that make up the pool? We tend to look at everything where we can, but there's definitely a lot of talk within the industry on where that needs to go and standardizing some of these data points. And so I'm actually involved with the Structured Finance Association. They've kicked off a few different working groups for some of the very specific asset classes within securitized. So, whether we're thinking about agency RMBS or non-agency RMBS or ABS, there are different data points that we should be thinking about. And then whether we are able to get the issuers to actually report on that. ABS, for instance, there are pools of cars that if you get the model number, that doesn't necessarily tell you whether it's an electric or hybrid or a gas vehicle. So the data points that we're getting don't allow us to dig in deeper. And so that's the kind of information that we're thinking through. How can we ask the issuers to provide this and continue to provide reporting on an ongoing basis? So certainly things to be worked on here.
And Joe, in the equity side, then, I suppose that's one of the reasons why we don't solely just apply a broad-based MSCI ESG negative screen to our universe, because if you did, then you'd be susceptible to their methods, their scopes, their preclusions to some degree. And so each and every, I suppose, rating agency has some of its own challenges, and that's why, as I think Allison said, you need to understand their methodologies, which is quite important. And for us, bottom-up fundamentals and materiality of focus is very, very important. In terms of pockets of less covered, I think these businesses are themselves businesses that need to make money, and so it's the large caps, liquid stocks in the developed markets are the ones that they are really well covered. We find that those equities that are listed in emerging markets, Asia, difficult markets like China, India, then those businesses are less well covered to some degree. MSCI being a bit of a shining star there, but generally that's where there's a bit less of a coverage. But just coming back to that scope difference of, as you said, limitations, then we have a position in our fund with Harbor in Shimano, which makes gears and brakes. It's a leader in gears and brakes for bicycles, and this business is an MSCI BB rated stock. And at Comgest, which isn't that great for MSCI, and for Comgest it's a 2 internally, which is near a 1 at the top. It gets really poor ratings because it's a family-owned business with a family-controlled board. The family still owns 20%, but actually, if you look below the hood and you dig into the culture of the business, their strapline, for example, is to get closer to nature, closer to people. The very culture in the business is predicated around family, around health and happiness, around the environment, and around cycling, which is great for the greenhouse gas emissions. And so, from that perspective, then when there's a bit of a shortfall, perhaps on the governance side, there's certainly something that we believe is more important on the environmental side. And so that's where the fundamental due diligence and views, and perhaps as an investor, the ability for you to add value and alpha rather than just blanket ratings or screens really comes to the fore and comes to bear. I wanted to just give you that example because it just really brings to light the limitation question that you had.
Thank you, Zach. Maybe moving on to the next section of the agenda. Based on the macro, we keep hearing that the ESG opportunity set continues to expand in terms of security type and just the number of companies embracing and adopting ESG practices. Hard to put a finger on in terms of quantification, but how have you seen that expand over time? For instance, versus today versus say 5 years ago. Be great to get your perspectives on that.
Sorry,
Yeah.
you broke up. yeah, you broke up there. Could you just repeat the last part of the question?
Sure, yeah. So if you could, provide some perspective on how the landscape has increased from, say, over the last 5 years in terms of just the number of companies embracing ESG today versus, say, 5 years ago.
Of course. Thanks. So I think, as I mentioned earlier, corporates wanting to appeal to an investor base, there's definitely been a trend from companies to provide more disclosure within their reporting, CSR reports, ESG reports, and certainly engaging more and more with the investor base and around ESG. So, for example, our ESG team have here at Comgest. There are 5 of members of our ESG team, and they sit alongside the financial analysts within our integrated research process. They've had far more engagement with companies today than they ever did 5 years ago here at Comgest. And so anecdotally, just the frequency of meetings from corporates around the world has meaningfully and markedly increased. But I also think if you look at if you followed a business for a very long period of time, like we have at Comgest, I mean, we've owned L'Oreal, Housing Development for over 10 years. Housing Development Finance Corp is held again in our Harbour International Fund. Then our India team has followed that for 20 years. And so you're able to actually assess whether a company's genuine actions rather than words or disclosures are leading to better outcomes and a longer sustainable earnings-driven franchise than a marketing slide or a presentation on ESG would otherwise do. And for us, that's quite important. So even though we've seen this prolific increase in ESG disclosures and reporting and engagement, we're able to, having that long record of following companies, be able to assess whether or not the company actually walks the talk, shall we say, which is a bit of an edge for us for now. So hopefully we can keep hold of that. I don't know if that answers your question, Joe. Hopefully gives some color.
Yeah, and I just add that, along the same lines, where our analysts are certainly hearing and seeing more mentions of ESGs on earnings calls and in their discussions with management. There's more data available, so the companies are disclosing more. Just anecdotally, the number of S&P 500 companies that cited ESG on their quarterly calls back in Q1 and Q2 of 2018 was between 5 and 6. And if we look at Q1 of 2021, 154 of those companies cited ESG specifically on their earnings call. So even just over a couple years, we've seen a significant increase in the number of companies talking about it in their quarterly calls. So that, I think, gives you the sense that this is something that management is prioritizing. And then our job as analysts is to look under the hood and see who's just talking about it versus who's actually implementing any policies that are driving change at their organizations.
Great. And speaking of looking under the hood, we did get a question in advance of the discussion from an audience member in terms of greenwashing. And it's along the lines of, there seems to be an incentive for companies and issuers to embrace ESG, right? Because the demand is somewhat investor driven. And so Allison, how do you separate those that are truly embracing ESG, they want to make a change, they believe in it, versus those that may be doing it in some sort of facade to kind of ride the wave of positive asset formation?
Yeah, I mean, it really just comes down to the analysts' expertise. So their knowledge of the sector, their knowledge of the management teams, and their overall, they're looking at, are these policies tied to any particular incentive? So is executive compensation tied to any of the ESG measures that the companies are talking about? Or is this, something that the management team is just talking about and they don't have any incentive to really drive that change? So that's, certainly one of the questions that we ask on calls. And others are asking it as well. So a lot of it is really just having the discussions to see if the overall team is able to talk about it too, right? Like if it's just one person who's in charge of ESG and they're the only ones that can speak to this versus, different people within the company having a really good understanding of where they're going, what their strategy is, and why they're doing that, then that's another thing that leads us to come to a conclusion on whether or not someone is really walking the walk or just talking the talk.
Exactly. I totally agree with you, Alison. I mean, we have, I think it's over 18 years of average experience in our ESG team. And so it's not their first day on the job, shall we say. And, when you have all of a sudden people coming to the fore with banging the drum on ESG, there is a healthy level of experience and cynicism and skepticism, plus, that long track record of following the company to be able to dissect, as you've just said, the wheat from the chaff, so shall we say. But just stepping back, what's interesting with that question, Joe, is, for us, quality growth, long-term investor, if we take it back to basics, then we like to invest in business models that are going to be growing for a long period of time. And if you think about the usual Buffett-esque 4 to 5 forces, barriers to entry, competitive advantage period, et cetera, then, as I mentioned, for a company to be growing faster for longer, it needs to be sustainable. Otherwise, it's not going to be, it's not going to exist for very long. And that's all stakeholders, employees. Otherwise, you're going to, have, employee walkouts or issues. Customers, in terms of, I suppose millennials, Generation Z, are more focused than ever before on product sustainability. They are your future terminal valuation, right? And whether it's paying the right amount of tax and not annoying the regulator too much. So all of those things encompass the sustainability of the business for a long period of time. And so when it comes to just presenting a quick update on, our water consumption has fallen from X to Y. Okay, great. But really, how material is that to that sustainability equation and long-term, focus of walking the talk and actually adding some real value? It's all very well and good, reducing your water consumption from X to Y, if you're, absolutely working your employees to the ground through COVID. Such that they have mental health issues, so it's that sort of focus that we, I suppose, rely on more than not. And lastly, I think just to add on that, in terms of COVID, we were pleasantly surprised that a lot of our holdings walked the talk, as you say, Alison, and delivered through action. We invest in Amadeus, we invest in MTU. These are 2 businesses in the airline travel industry, the forefront of this crisis. And whilst they've had to cut costs, they went above and beyond at trying to maintain the employee workforce, specifically in R&D, through this crisis. You only need to look at L'Oreal, LVMH, and Unilever, who again went above and beyond at helping society address the crisis, where they didn't have to. So LVMH, committed around $1 billion to the COVID effort, and also changed some of their fragrance manufacturing footprint to produce hand sanitizer for the crisis. So back in its peak. So it's those sorts of anecdotal actions that for us are far more important than anything else.
Great, thank you. Another question submitted by the audience in advance of the discussion. This one's geared to Allison. What are some unique fixed income security types that have been created to draw in ESG investors, for instance, green bonds, social bonds, and then what makes them green or social, and how do you evaluate those versus, say, standard issues?
Yeah, it's a great question. And there's certainly been a lot of focus on this particular part of the market. They are an important and growing piece, but still very small in comparison to the overall fixed income market. So there are the use of proceeds bonds, and those are the green, social, or sustainable bonds. where the company issues the bond and they commit those proceeds to going towards a green project, something that is good for the environment, a social project that, think affordable housing, et cetera. And then sustainability bonds, again, a use of proceed bond. So the proceeds are going towards projects and that are some combination of green and social projects. So those are the use of proceeds bonds, and there's frameworks that that ICMA has put together, but they're voluntary. So there are reporting frameworks out there that the companies are submitting to. Again, it's a little bit touch and go on where that stands, and there's different regulators coming in saying, well, we're going to create our own framework, et cetera. So we're watching that market. And then the newer, or I guess more popular and growing in popularity bonds are the sustainability linked bonds. And these are bonds that are issued for general corporate purposes. You don't need to use the proceeds for specific products or projects, but they are tied to ESG KPIs. So there's overall company level KPIs that are associated with some sort of ESG metric. And if those KPIs are not met, the coupon can change on that bond. So the coupon would step up and the bond would become more expensive for the company that issued it. So they would be paying a higher coupon. It can go in reverse. So if they meet these goals, then the coupon can step down. So there's different structures out there that are available. Some of the things that we think about when we're evaluating this is whether or not we like the credit, whether we like the structure, and whether we like the price. And that is what we do for all of our bonds. And so the label itself really is just an add-on for us, where we want to know that the companies are really behind these projects. They're thinking through this. It's authentic, but it doesn't override our overall credit analysis on the actual companies themselves. So that's kind of how we're thinking about it. And there's, like I said, the voluntary frameworks are a little bit difficult. So it gives you a little bit of pause. There's certainly been a lot of headlines about greenwashing. But one of the other things I will say is that these are under scrutiny, right? So a company is not going to issue a green bond and not think about the implications if they don't follow through with those reporting requirements or what their investors are looking for. So that does give us a little bit of comfort, knowing that there is a lot of scrutiny out there. There are people looking at this, and while it might not be a formal regulation, it's certainly something that the companies can't just loosely issue.
Thank you very much. Now, moving along and digging a bit deeper on the micro level, we'll start with Zak. Zak, can you highlight a company? You've already named a few examples, and describe what makes them score well based on your firm's ESG criteria, and then maybe highlight a company in a similar industry that maybe doesn't score so well and detail why.
Yeah, sure. So I think, I already mentioned Shimano, so perhaps I could extend a little bit more on that. So for us, in our internal rating system of 1 through 4, bear in mind 4 is still investable. It's just a business which requires some improvement, where we can engage and helpfully move them up that ESG chain, if you will. And the reason it's still investable is because of our quality focus. So we've already excluded quite a few of the poorer ESG culprits, shall we say, below 4s. So a 2 for us in Shimano was ascribed predominantly, as I mentioned, because of its culture in and around employees, the environment, and its very purpose. So its very purpose is one of health and wellness, one of exercise, one of getting, as I mentioned, the slogan of closer to nature, closer to people. And if I remember correctly, something like 40 to 50% of their own staff cycle to work every single day, then you have complete and utter buy-in from the employees as well. And this is despite, as I said, their governance pitfalls, if you will, per some of the MSCI ratings. As I mentioned, family-owned, Japanese stock, for example. So that just hopefully gives you a flavor for why we've scored it really well. When we look at the S, very strong. When we look at the E, very strong. When we look at the governance, yes, we admit there are some weaknesses as identified by MSCI. But the other nice thing about Shimano is that we have a lot of exposure and face time. So when we try and engage with the company, they're very receptive, to the extent now that we have companies that actually ask us for advice, if you will, particularly in Japan, particularly in emerging markets, not so much developed markets, of course. They ask us for advice. So Pigeon, for example, we had a great engagement outcome with Pigeon. Pigeon is a manufacturer. Alison, I see you've got a picture of two babies in the background. They manufacture the baby products and baby nipples and things like that. And in the US, it's a Lassenau product. Now, this is a business in Japan that is a leader in its industry. It had no female boards of directors at all. And through engage, now this is obviously incongruous, right? Breastfeeding. And through our engagement and active recommendations, they've appointed in 2018, 2019, more than 2 female boards of directors. So that's the kind of engagement that we like. And for that, we've upgraded them from a 4 to a 3, if you will. So that gives you some flavor for how we arrive at our ratings. I mean, I could go on, but in the interest of time, hopefully I've given you a bit of color there. We've got some great examples in and around. The one thing I'll just mention in and around companies, we're not scared to be different. We're not scared to take on businesses that require engagement, because that's where we can actually affect some positive change. So, you know, to drop a bomb, you know, we used to invest in Hikvision, Hangzhou Hikvision, which we actually sold because of failing in our engagement. We tried to get them to renege on some contracts which were in the Uyghur province of China for, you know, humanitarian issues, and they couldn't do it. And so we drew a line in the sand and we exited the position. And that was after active engagement. So we're not scared to be different, and we're not scared to engage.
Great. That's
sorry, I just left it there for the interest of time.
No, that's really interesting. I've got to update that picture because the twins are now much older than that, but I was in the office and thought I'd bring it home since I don't go in there anymore, and we seem to be on this trajectory of staying home longer. But you know, just to touch on our research process and how we come up with our ESG leaders and laggards and provide some examples of how we differentiate. We again are sector specialists, so our research analysts have developed a framework that allows us to identify key issues, key ESG issues that are material for their sectors. So we have a whole framework that we've built out, and it really just helps to guide the analysis and focus on the material factors that could influence the credit, and that drives our ESG rankings. So for each of the key issues, we think about the risks and the opportunities, we assess how the issuer is addressing those. We're thinking about the potential for regulatory and compliance costs associated with things like GHG emissions, or the potential for higher costs of energy and fuel consumption, or exposure to climate change and the risk to operations or damage to properties or facilities, et cetera. So those are some of the things that we're thinking about as we analyze a company. And then we go and we create comp sheets within each sector. So we're looking at the names within each sector and comparing them to their industry peers. We're assessing who's a leader in the space and who is a laggard, again, based on those key issues. So we gather data from numerous different sources, and we use the framework to provide that ESG ranking. So within the utility space, for example, we have a Florida-based utility that we rank as a leader. We happen to agree with MSCI's rating. They are ranked AAA by MSCI, and they have really led the industry in their environmental statistics. So they rank above average within the industry on key environmental issues like water stress and toxic emissions and waste. And then they're the leading provider in renewable energy. So they're the largest owner of wind and solar in North America. and they continue to develop clean, renewable energy sources. So it's evidenced in their capacity and also their commitment to continue to produce that capacity. On the social side, they really score well here too. And, you know, to Zak's example of the COVID pandemic, highlighting where some of these companies are really taking this to heart, this company voluntarily suspended electrical disconnections during the COVID period in order to ensure that everyone had access. And so that was just something that they did to highlight some of the, you know, the more social aspects. And then of course, on the governance side, we don't have any concerns. I won't highlight any major things there, but they do have a pretty diverse board, and they're thinking through how all of this relates to the overall ESG. So on the other side of the fence, and sticking with the utility sector, we have a Georgia-based utility that we highlight as an ESG laggard. And we actually differ from MSCI here. MSCI rates them as a single A, but we believe that their environmental scores are not great, especially compared to different companies within their sector. Their GHG intensity is well above industry average, and they just don't have the renewable energy sources that we've seen in other companies within this sector. On the social side, they score some negative points based on their handling of some over budget projects that they've needed to actually scrap. And they got into some scuffs with the regulators about those projects. They also had some incidents with indigenous populations while they were going through those projects. And so just overall, you don't get a good feeling for this company on their social scores as well. So those are some of the things that we're looking at when we're thinking through some of these companies, and using our key issues map as a guide to think about what makes sense and what impacts these companies in our credit view.
Thank you so much. Mary, perhaps it's a good time to pull up the presentation, cover the executive summary. I'd also ask the audience if they have any questions they'd like to pose as part of Q&A. Just to briefly summarize, I'd say 4 main points here. You see rising ESG attention and demand has really given way to new security types. Allison talked about some of those within fixed income. Also wider corporate adoption and increased regulatory considerations, which it's really important to be on top of. It also seems like there's no single monolithic definition of ESG investing. However, incorporation of ESG can enhance both equity and fixed income processes and help address key company and issuer advantages, risks, as well as potential industrial impacts like regulation. Also, third-party ratings data. There are some inconsistencies. It can be helpful, but coverage limitations in more esoteric areas, maybe like within munis and securitized, as well as emerging markets equities, does provide possible advantage for active management, understanding the DNA of these companies, going a level deeper to really uncover opportunities for clients and investors. And then lastly, ESG has just steadily become the new norm, right? We're hosting a webinar on it, and you see it, asset managers that are behind the curve are now rapidly attempting to catch up. Whereas here we have managers such as Comgest and Income Research and Management that have maintained well-tenured, formalized ESG practices, which really helps them identify key investment risks and alpha opportunities for their clients. Not seeing any questions come in, Mary, so maybe perhaps I'll kick it back to you.
Sounds good. Well, to close, we appreciate everyone's time today. In terms of next steps, I cannot overemphasize how happy we would be to further engage with you on the topic of ESG. Whether you have specific questions, a product need, or just want to brainstorm on this topic, we are very, very open to those conversations. Regardless of whether you'd like to speak with a Harbor contact or have your Harbor representative get you in touch with one of our sub-advisors, please reach out to your dedicated Harbor contact and they can get that ball going. That's either going to be me, Mary Gordon, Robert Atwell, Ben Cull, Scott Sinclair, or Joanna Vogel. If you don't know who your Harbor contact is, please feel free to email clientengagement@harborfunds.com Again, that's all one word, clientengagement@harborfunds.com, and they will put you in touch with the right person. Finally, there will be a replay of today's call. We will send that link as soon as it's available, so please feel free to listen again or share the link with your colleagues. That about wraps it up. We hope you enjoy the rest of your day. Thank you.
Thanks, Alison. It was good to see you again. Thanks, Joe.
Bye-bye.
Thank you all.